On December 2nd, 2001, the largest corporate bankruptcy in American history was filed in a Manhattan courthouse. The number at the center of that filing was $63 billion in assets. Assets that, as investigators would soon discover, had been constructed almost entirely from accounting fiction. Enron Corporation had been named America's most innovative company by Fortune magazine for 6 consecutive years. Its stock had traded above $90 a share. Its executives had collected hundreds of millions in compensation. And then, in the span of roughly 6 weeks, the whole structure came apart. What remained was not a company. It was a set of spreadsheets, and the lights had never actually been on. Enron began as something genuine. Founded in 1985 through the merger of Houston Natural Gas and Internorth, it was, at its origin, a straightforward natural gas pipeline company operating in the American Midwest and South. The deregulation of natural gas markets in the late 1980s changed everything. Enron's leadership saw an opportunity not just to transport energy, but to trade it, to become, in effect, a market maker for a commodity that every home and factory in America depended upon. By the early 1990s, Enron had reinvented itself as an energy trading company. It created the gas bank, a mechanism that allowed producers and buyers to lock in long-term prices through Enron as an intermediary. The model worked. Revenue grew. Wall Street took notice. And the company began attracting a particular kind of talent, aggressive, mathematically sophisticated, and deeply incentivized by stock-based compensation. The culture that took hold in Houston was one of relentless performance pressure. An internal evaluation system, known internally as rank and yank, graded employees against one another on a forced curve. Those at the bottom faced termination. The system rewarded deal-making above almost everything else, and it created powerful incentives to book revenue quickly, regardless of whether the underlying economics ever materialized. Enron's accounting methodology became the engine of its apparent success. The company was an early and aggressive adopter of mark-to-market accounting for its trading contracts, a method that, under certain conditions, is entirely legitimate. But Enron applied it to long-term energy contracts of extraordinary complexity, booking the estimated present value of a deal's future profits on the day the contract was signed. The cash might not arrive for years. The assumptions underpinning the valuation might be wildly optimistic. None of that was visible in the quarterly earnings release. By the late 1990s, Enron had expanded into broadband, water utilities, and international power projects. Its trading operation had grown to encompass electricity, weather derivatives, and eventually bandwidth. Revenue figures climbed to $100 billion in the year 2000, placing Enron 7th on the Fortune 500. Analysts adored it. Investment banks competed aggressively for its business, and the stock price reflected a company that seemed to have discovered a permanently superior model for creating value. What almost no one outside a small circle understood was that the revenue number was largely a product of gross trading volumes being reported as top-line revenue, a presentation that inflated the appearance of scale, and that the profits underpinning the stock price depended on a growing and increasingly opaque network of off-balance sheet structures that were about to demand very close attention. The mechanisms that would ultimately destroy Enron were not hidden from every set of eyes. They were hidden from the public, from most shareholders, and from the analysts whose buy ratings sustained the stock price. But within the company, and within its network of advisors, the architecture was understood by enough people that its eventual exposure was, in retrospect, a question of when, rather than weather. At the center of the structure were entities known as special purpose entities, or SPEs. These were legally separate companies created to hold assets and liabilities that Enron did not want appearing on its own consolidated balance sheet. Under the accounting rules of the period, an SPE could be kept off Enron's books if an independent outside investor held at least 3% of its equity. In practice, as the Powers Report, the investigation commissioned by Enron's own board, later documented in detail, many of these entities were not genuinely independent. They were capitalized in part with Enron stock, managed by Enron insiders, and structured in ways that transferred risk back to Enron rather than away from it. The Powers Report identified two clusters of SPEs as particularly significant: the LJM partnerships and a series of entities with names drawn from Star Wars characters: Chuko, Jedi, Raptor. The LJM partnerships were managed by Andrew Fastow, Enron's own chief financial officer. According to the Powers Report, Fastow earned at least $30 million in management and transaction fees from the LJM entities. Fees paid, ultimately, by Enron itself, and not disclosed to shareholders in any meaningful way at the time. The Raptor vehicles served a specific purpose. Enron had made large investments in technology and broadband companies during the late 1990s boom. As those investments declined in value, the Raptors were used to hedge the losses. But the hedges were backed primarily by Enron's own stock. When Enron's stock price fell, the Raptors' ability to cover the hedges deteriorated in lockstep. The structure did not transfer risk, it concentrated it. Enron's external auditor was Arthur Andersen, one of the 5 largest accounting firms in the world. Andersen collected both audit fees and consulting fees from Enron, a relationship that critics argued compromised its independence. The SEC's subsequent findings and related proceedings established that Andersen's audit work failed to catch, or failed to adequately flag, the accounting treatments that made the SPE structures possible. The auditor's Houston office later destroyed documents related to the Enron engagement after learning that the SEC had opened an inquiry, a fact that would have consequences of its own. By the spring of 2001, a small number of analysts and journalists were beginning to ask questions that the company struggled to answer. In a now documented analyst call in April of that year, Enron's chief executive at the time responded to a question about the company's balance sheet by calling the questioner an asshole. The call was recorded. The exchange circulated. It did not yet break the narrative, but the questions were no longer coming, only from skeptics on the fringe. Sharon Watkins was a vice president at Enron. In August 2001, she sent a memo to Kenneth Lay, Enron's chairman, warning that the company might implode in a wave of accounting scandals. The memo, which later became part of the congressional record, described the Raptor structures specifically and expressed concern that Enron's accounting was inappropriate. Lay sought legal advice in response. The lawyers who reviewed the matter were, according to subsequent findings, not given full access to the relevant documents. No restatement was announced. Watkins remained employed, and the memo remained internal. What changed the trajectory was a sequence of events in the autumn of 2001 that compressed months of slow deterioration into weeks of freefall. In October, Enron announced a third-quarter charge of $1.044 billion, attributing a significant portion to the unwinding of the Raptor hedges. The announcement was accompanied by a reduction in shareholder equity of $1.2 billion, a correction the company attributed to an error in the accounting treatment of an SPE called CHUCO. That correction alone was enough to trigger a review of whether Enron's prior financial statements needed to be restated. On November 8, 2001, Enron restated its financial results for the years 1997 through 2001. The restatement reduced previously reported net income by $586 million across those 5 years. It also added approximately $628 million of previously undisclosed debt to the balance sheet. The restatement confirmed what the skeptics had argued. The profits that had justified the stock price had been, in material part, illusory. Credit rating agencies, which had maintained investment-grade ratings on Enron's debt through the autumn, now moved rapidly. A downgrade to below investment grade, junk status, would trigger provisions in many of Enron's trading contracts, requiring the company to post additional collateral it did not have. Dynegy, a smaller Houston competitor, entered into merger discussions and agreed in principle to acquire Enron for approximately $9 billion. The deal collapsed on November 28th when Dynegy withdrew, citing material adverse changes in Enron's condition. The credit rating agencies downgraded Enron to junk on November 28, 2001. Trading counterparties stopped doing business with the company within hours. Enron's commercial paper market, the short-term borrowing that funded daily operations, evaporated. On December 2, 2001, the company filed for Chapter 11 bankruptcy protection in the Southern District of New York. At the time of filing, Enron listed $63 billion in assets. Approximately 20,000 employees lost their jobs. Many had held significant portions of their retirement savings in Enron stock through the company's 401k plan, which had restricted their ability to sell company shares during a critical window. That stock was now worth, for practical purposes, nothing. The legal consequences that followed Enron's collapse were among the most extensive in the history of American corporate prosecution. The Department of Justice established a dedicated Enron task force. Over the years that followed, more than 20 individuals pleaded guilty or were convicted at trial in connection with the fraud. Andrew Fastow, the chief financial officer who managed the LJM partnerships, pleaded guilty in January 2004 to 2 counts of conspiracy to commit wire and securities fraud. He agreed to cooperate with prosecutors and was sentenced to 6 years in federal prison. His cooperation was instrumental in the cases that followed. Jeffrey Skilling, who served as Enron's chief executive officer until his resignation in August 2001, was convicted at trial in May 2006 on 19 counts of conspiracy, securities fraud, making false statements to auditors, and insider trading. He was sentenced to 24 years in federal prison, later reduced on appeal, and through a resentencing agreement to 14 years. He was released in 2019. Kenneth Lay, Enron's chairman and the public face of the company through its final months, was convicted on 6 counts of fraud and conspiracy in the same trial as Skilling in May 2006. He died of heart disease in July 2006 before sentencing. Under a legal doctrine known as abatement ab initio, his conviction was vacated upon his death, meaning no formal judgment of conviction stands against him in the legal record. Arthur Andersen, the auditing firm, was convicted in June 2002 on obstruction of justice charges related to the document destruction. The conviction effectively ended the firm's ability to operate. Clients departed, and the firm surrendered its licenses. The Supreme Court later overturned the conviction on narrow jury instruction grounds. But by then, Arthur Andersen had ceased to function as a going concern. One of the 5 largest accounting firms in the world was gone. The Securities and Exchange Commission brought civil enforcement actions against numerous Enron-related parties. Major financial institutions, including several large investment banks, paid substantial settlements in connection with their roles in structuring transactions that facilitated Enron's off-balance sheet accounting. The total value of the Enron bankruptcy estate's recoveries for creditors ran into the billions, though unsecured creditors received cents on the dollar. Congress responded to Enron and to the near-simultaneous collapse of WorldCom by passing the Sarbanes-Oxley Act in July 2002. The legislation imposed new requirements on corporate boards, external auditors, and senior executives, including personal certification of financial statements by CEOs and CFOs, carrying criminal penalties for knowing misrepresentation. The employees who lost retirement savings received some recovery through litigation settlements, but the amounts were a fraction of what had been lost. The pension funds and institutional investors who held Enron shares at the peak lost billions. The human cost was distributed across thousands of people who had been told, repeatedly, and by the people responsible for telling them the truth, that the company was sound. The lesson Enron leaves in the record is straightforward. When the complexity of a financial structure serves primarily to prevent outsiders from understanding it, that complexity is not innovation, it is concealment. And concealment at scale has a cost that is always paid by someone other than the architects.